Hello, everybody. I'm your host, Derek Bird, here at StopStrugglingNow.com. And today, we're going to talk about what does it take to improve your credit score. That's right, those primary trade lines, the authorized user trade lines. You need those to boost your score fast? Well, we'll talk about how do you increase your score slow. Welcome, everybody. So please, like, subscribe, and click the bell below so you get the latest updates. Now, let's get to it!
All right, welcome back. Let's get down to business of credit building. Everybody wants to build their credit fast. Nobody wants to hear it's going to take months to build your credit. So I'm going to talk about two things like we always talk about. Thank you for being here. Thank you for coming, and I appreciate your support. We have over 4,000 subscribers. We're going to start with you have to understand how your score is calculated. Every video I do that's regarding credit repair, I always get into this. I'm going to use a different illustration this time. FICO scores, which is fine, but again, it's regarding your payment history. So when you realize your payment history, meaning your on-time payment history, meaning it needs to be 98, 99, or ideally 100% at all times. This is the only way your credit score can go up. As soon as you go 97% or less, then your credit score most likely is going to go down. So if that's 35% out of 100, which is 35 out of 100, and then when you add in 30%, it says here amounts owed, which is what we call debt utilization. So if you owe $1,000 and your credit limit is $3,000, that means you have a 30% debt utilization. In order for your debt utilization and your credit score to go up, you need it to be 29% or less. So you would have to reduce the amount you owe. That $1,000 would have to be reduced to $900 or less in order for you to have your credit score go up. So when I say $900 or less, that means you owe $900 or less and your credit limit is $3,000. That's an example. The same would go if you have a credit limit of $10,000, then you need to owe $2,900 or less in order to be 29% or less. That helps improve your credit score. So when you combine payment history and credit score, debt utilization, you're at 65% of your score. So you can see if you're just handling these two things alone, this can impact your score and improve your score. And so you want your debt utilization, just so you know, to be under 10%, be 9% or less, ideally somewhere between 5% and 7%. Okay? That's where you want it to be. Now, moving into the next phase is 15%. That is length of your credit history, as you can see over here on the right. 15%. So if you started out and you have, let's say, new credit, where you have 1 year old as your credit report, that's not ideal, but you have to start somewhere. Each month helps build your credit. That helps build your payment history. That helps build your length of credit. These are items that help improve your credit score. What you want is 7 years on average is ideal. 5 years is better. And some of you are saying, hey Eric, I just started out, my credit history is only 2 or 3 years old because I mistakenly closed some accounts. Right, if you close an account and it's 10 years old, that is taken off your credit report, so to speak, as far as calculating your length of history. So therefore, this is why if you have good credit on older accounts, you'd never want to close those, because that'll reduce your age, because now when you get new credit, they average it out. So when you're talking about length of credit, let's just say I have one credit card that's 10 years old. And then I wake up tomorrow and say, well, my credit score is 750 and I'm going to apply for two credit cards. Now I got 2 credit cards. Each credit card now starts with a 0. So now they divide all 3 credit cards. That means now your length of history is reduced to 3 years. That is not ideal, but at least you're going to have 10 years of payment history. And hopefully your debt utilization is low. So that will not reduce your credit score in a significant way. So all I'm trying to say is those are the three things, and that brings up you 80% of your credit scores based on length of credit history, payment history, and amounts owed. So if you build your credit score slowly, this is the template right here. If you want to build your credit fast, I'll get into that real quick, because that is what everybody usually needs. They usually need some 2 to 3 to 4 month build fast. So therefore, this is why people use authorized user trade lines. Because now, with an authorized user trade line, you can receive a trade line of $20,000, for instance. It can be anything. But you could be one of these people that says, well, I only have like 1 year of length of history. My debt utilization is at 35%. And my payment history is only 1 year. So now I turn to you and say, okay, no problem. Get a $20,000 AU trade line that has like a 7-year payment history. What that'll do is you'll have a payment history of 35% for 7 years. You'll have your debt utilization under 29%. Ideally, that'll probably drop it to about 10%. And then you have length of credit history is now 7 years. So now your 1 year and 7 year, you divide that, and now you're going to be around a 3 year, 9 month, 4 year length of history. And that'll be your average now. So now you've brought up the 80% of your score has now been affected, which now means your credit score will rise, because now you're under all of the programs that help you increase your credit score. And with an AU trade line, we can increase your credit score within 10 to 15 days as we're speaking. So if somebody needed to boost their credit score up, and we can see on your credit score how it will benefit you, this is how we do it. That's how we do it fast. So you can always hit me up at eric@stopstrugglingnow.com, and we can go over your credit. I do this for free. I don't charge. The only thing I charge for is when you guys decide you want to do business credit. I have that business builder program, but you can still email me, call me, and I'll still tell you what to do for free. But the business builder credit program, it's actually a step-by-step online course, tutorial type of thing, and it helps you. Once you complete each step, it tells you what you're qualified for next. You don't have to guess. You'll know once you do this step, you can apply for the next step and the next step and the next step. It's self-explanatory, and then there's people on the phone that'll help you along the way for your first year of being in the business builder. But again, this is regarding personal. And then, of course, 10% of your credit score is a credit mix. So therefore, if you decide that you need a credit strong or self-lender, that's a different type of loan and revolving type credit. If you're a car loan, that's a credit mix. That's 10%. So if you have a credit card and things like that, that's a credit mix. Credit card, a car loan, any other type of loans from a bank, those are different. Those are credit mixes. And then 10% of your score is new credit. So they always want you to see new credit. So here's the deal, everybody. For the long term, you need to have 10 or 11 primary trade lines. Okay? Authorized user trade lines only stays on your credit report for 3 to 4 months. That's all we guarantee them for. And if anybody needs one, you can always email me or call me, and I'll hook you up. But they only stay. An AU trade line only stays on your credit report for 3 to 4 months. And then 10% of your credit score is, now you have the 10 or 11 trade lines, primary trade lines. What you want to do is, occasionally, you just want to add something. You don't have to use these credit cards or any other type of loan that's reporting on your credit file. You just need to have 10 that's reporting. So for instance, if you have a Capital One, if you have a Barclays, if you have a Chase, you have a car loan. Okay, all these together adds up, you have 10 or 11 cards. But 10% of your score is, I'm going to apply for something else and get this. And if you're doing something in your life, there's always some sort of credit product that you may need temporarily. So you should always look for something. Some people have 20 cards, 15 cards, 30 cards. just keep in mind to keep your debt utilization under 10%. You can have as many cards as you want, but try to keep them under 10% across the board. It goes based on all of your credit cards. So if you did have 20 credit cards, and I can't give you an example at this point, but if you had 20 credit cards combined, all the credit cards had a $100,000 credit limit combined. They all have a $100,000 credit limit. Then what you're trying to do, then you would have to keep your amount owed $29,000 or less. And ideally, you would only want to owe $5,000 to $7,000 on revolving your cards around. That would be your ideally, and then of course your score would be 800 easily. It'll be over 800 if you're doing it like that and had that type of limit. But then you can afford to say, okay, I'll apply for something else. And it oftentimes happens, you sell a house, you sell a property, you sometimes do things where it'll, give you some sort of new credit. So you don't really have to worry about that. It'll take care of itself. But if you want to build your credit score to where you're going to be around 800, high sevens, then you have to do all of these. This is why I always have this image on the screen so you understand what impacts your credit score. All right? And that's how simple it is. So if you want to build fast, you do the AU, you do Ox Publishing, Hutton Chase, your score can boost up in 30 days real fast, because Ox Publishing and Hutton Chase, they report to 2 credit bureaus. And if you tell them that you want to pay your first monthly payment right now, they'll add it to your credit file within the 30 days. So you can get everything done in 30 days. An AU trade line you can get as soon as 10 days from now. So keep that in mind. Now, let's get down to the building slow, because I'm not trying to make this long. Building slow. What we're talking about building slow is where you are saying, okay, some of you may have good credit already. Those people who do not have good credit, but both of this will apply. You don't need to worry about building something fast, because you're not saying, hey, I'm buying a car where I need my interest rate low, or I'm buying a house, I need my interest rate low. Somebody contacted me the other day, they need a HELOC and they need their score to improve by about 20 or 30 points. And so it's a simple matter that all I have to do is a simple thing where all I have to do is sorry, I have a call coming in. All I had to do was get him an AU trade line, because he just needed a 640 credit score or higher, and he has a bank relationship, and they were going to say, well, you can get a HELOC. And so easily an AU trade line does the job, and we can have it in 10 days, so he can go in 2 weeks and get his HELOC. And by the way, that's a home equity line of credit. If anybody can get a home equity line of credit right now for the next 6-7 months, and you give you a low interest rate, you should start thinking about taking them up on that, because you have to think about home equity lines of credit go out the window if your home price goes down. If your home appraisal goes down, then your HELOC value goes down, the amount of money that you can get from your HELOC line of credit. So that is something that I just throwing in. That's just a nugget. So building it slowly, what you want to do is, you don't need an AU trade line to build slowly. You're not in any rush to or need to have your credit improve rapidly. So you can do it slowly. And by doing it slowly, it's a little bit different program, because what you would want to do is, keep in mind, hard inquiries do matter. Once you go over 4 hard inquiries in a 2-year period, then you're going to be penalized, or can be penalized from that point on, because they don't drop off. So unless, well, there's a way you can get them off, but you have to send in and do just like you do credit repair. But let's just say you're not one of these people that needs to pay credit repair agencies or want to send in letters. But once you get over 4 in a 2-year period of hard inquiries, then you can be penalized. So what can happen is, some people say, hey, I just got my jewelers, New Coast Direct, and all this, and I reduce my debt utilization, obviously. I have new credit, but my score went down. That's the reason, because sometimes your hard inquiry can cost you not only 2 or 3 points, sometimes I've seen as much as 15 points taken off of your credit score because of a hard inquiry. But don't worry, because once the next payment history shows up and once the debt utilization settles in and once the new credit 10% kicks back in, then it will overtake the 15-point loss. It just may take 1 month or 2 months for that to happen. And in the meantime, you're getting other payment history from your other credit cards. And plus the new credit, you're adding payment history as well. So now you're activating almost 90% of your credit score. And now it'll start rising. So those are the key things. But we're going to go slow. So going slow means what you want to do is, if you have bad credit or if you have good credit, it does not matter. I'm going to do some recommendations because we're going to go with primary trade lines that everybody who's been a former subscriber and current subscriber is familiar with. And by the way, I got an alarming news just yesterday where a person asked me, he called me up and said he needs AU trade lines. He's trying to do something. We start talking. He says, how come you haven't been putting out any videos? He goes, I'm a subscriber. And I said, what are you talking about? I put out like videos every week. He goes, no, I haven't seen any video in the last 4 months. So I don't know what's going on with YouTube, but he claimed that he actually has subscribed. So then I said, well, have you clicked the bell? And I said, I don't know how YouTube does their thing, but everybody who's paying attention to this, please subscribe. But not only subscribe, apparently you have to click the bell as well. So just make sure that you actually subscribe and click the bell and double check. A lot of you may be subscribers and you may be in the same boat where you may not be getting any of the videos I'm putting out but once in a blue moon. But this guy says he hasn't gotten one in 4 months and thought that I wasn't doing anything. So just keep in mind, that's the kind of thing when you're trying to help people and trying to give people some game that actually can kind of almost get you out of the doldrums and get you on your financial right path. The powers that be do not like to have that information out there, even though it's readily available. So anyhow, let's get back to building this thing slowly. So My Jewelers Club, the reason why I say My Jewelers Club is because it's a $5,000 trade line, okay? And as you can see, how this all starts is whatever you buy, you put down 50%, but you have to order $100 or more. And when you do that, you have a 1-year membership up front. So they're going to be, after you pay off what you owe, because generally whatever you buy, then they make you pay $30 a month until it's paid off. And then you have your 1-year membership. So for 1 year, you'll have on-time payments and your debt utilization will be reduced. And it'll help you out. It'll for 1 year. And they report to all 3 credit bureaus. New Coast Direct, which I'm not on their page. But New Coast Direct is under the same program. They too have a $5,000 trade line, but they report to 2 credit bureaus. And again, it'll help with your debt utilization. It'll show payment history, and also they have a 1-year program. So therefore, you'll have 1 year of reporting. So that's how you start it off. And then my third, that I say the 3-prong attack is, now you go, and if you can qualify for Discover It card, I suggest you do that. If you have to qualify getting a secured Discover It card, I would recommend you do that. And the reason being, because after you get you have to put money down for the secured, so anybody can qualify. And after 6 months of on-time payments, so what you want to do is charge $100 and then pay the 15 or $10, whatever it is a month for 6 months. And then on the 7th month, they're going to send you a letter and they're going to say, hey, it's great. You've been on time payment. It's awesome. We'll give you back your deposit and we'll make this unsecured and we'll raise your credit limit. So now you have an unsecured credit line with Discover, and it does matter who you have credit cards with. So in other words, there's tiers. When you have Discover, when you have Bank of America, Wells Fargo, Barclays, Chase, Capital One, those credit cards are from big banks and they hold more weight on your credit report. Just so you know, let's say they are worth 50 points, right? maximum. Well, then let's say I go to my unknown bank around the corner. Their credit card could be worth a maximum value of 30 points. There is a tier, but they don't tell you this. So just keep that in mind when you're doing anything with business. But starting out, this is building slowly because you're getting all the factors that you need. All these 35%, amount owed, debt utilization, new credit, length of history. You're starting to build a history now. And a mix. 10%, you're utilizing 100%, activating your credit score to where you can improve it. And so that's the reason why I say these are the first 3 or 4 steps you need to get. And then quick Capital One. There's a quick silver card. And notice here it says credit level excellent. Well, Capital One also has credit cards for people who do not have great credit, and they will give you a card. As long as your credit score is, I think it's 580 is the cutoff, is about the lowest you can get. So if you have 580 and up, you can get a Capital One Quicksilver MasterCard, I believe. That's what the score is. But you can, and that'll be unsecured, by the way. So you can get that too, and then all you have to do is just monitor your stats, so you know what's required. Once you know what's required to boost up your credit score, then there's no reason for you not to be able to fix your credit score. Even if you have bad credit, you can start building. Here's the secret, guys. If you have bad credit, the good news about it is the older it is, the less weight it has on your credit score. So when people say, I have a collection, you have a new collection, that has more weight than a collection that's been on your credit report for 3 years or 5 years. Because at the end of 7 years, that collection comes off. You don't have to worry about it after 7 years. But in the meantime, most people think that a collection that's 5 years old, yeah, it does have a little minor derogatory effect on it. But if you were to start building your credit score all along, you could offset that easily. So the older bad credit gets, the better it is for you. So that's why you need to start building your credit now, even if you have bad credit. Some people say, I have bad credit, I don't want to build my credit score. Don't worry about none of that. Start building now, because when it falls off, you're going to be happy as hell. All right? So with the slow part, I also have other factors that people have heard me talk about. The Hutton Chase, the Ox Publishing, they're on here. And they now report to 2 Equifax and Experian credit bureaus. And with that said, they can help you as well. They have, Ox Publishing is a $2,500 primary trade line. And here they are right here on the front. And everybody does a hard inquiry now, guys, because of the laws. Because the days of people, and the reason being, people sending in false information, people trying to use CPNs, people trying to use other dead people and their names and things like this. So now they're doing hard inquiries because the credit bureaus and the credit collection agencies and the financing companies are just getting tired of people fraudulently getting credit, and it's not even them. So now everybody gets a hard inquiry. So as you can see, they're saying they report to these 2. Now, Ox Publishing and Hutton Chase, they're a little bit different story, because even though you buy something, you put down 50%, that doesn't mean that they just give you the use of them for a year. You're not actually in the club. So now, after you pay them off, let's just say it takes you 4 months. Again, you order over $100, you put down 50%. Let's say 4 months, you pay it off. At the end of 4 months, you have a choice. Either you re-up and buy other products and keep going like that, or you join their club, which means you're going to be paying roughly $20 a month or something thereabouts, and then you'll receive reporting on your credit file. So these are the kind of things. This is what you would need, is money. Once you build your credit score past like a 680, You don't need to do any of these methods with My Jewelers, New Coast, Hutton Chase, anything like that, because you'll be able to apply for normal credit cards, like a normal Discover straight out, like a normal Capital One, a normal Chase, a normal whoever you want card. But if you're below 680, then sometimes it's hard to get any unsecured credit cards, except for, like I said, the Capital One does have a card, their Quicksilver card, that they usually, not this particular one with cash back, but they have another one that you can get a credit card for. So hopefully everybody understands how you build slowly and how you can start building slowly like now. Because even if your credit is bad, the reason why I started with My Jewelers, New Coast, Ox Publishing, Hutton Chase, and Discover It is because this qualifies everybody. Even if you have good credit and you need your debt utilization down, My Jewelers, New Coast Direct, that's $10,000 right there to offset whatever your credit utilization is. So that's all you can, and in fact, you can get all four of these is $14,000. If you got My Jewelers, New Coast, Ox Publishing, Hutton Chase, that would be $14,000 to offset against any derogatory credit or even good credit where you need your debt utilization down real fast. That's how you can get it done. So these are the factors that you need for building slowly, and you keep building. You need 10, 11, or more. Once you hit 10, that's good. And I'm going to give you an example of what happens, because people don't realize the power of having more credit cards. Because let's just say you lost your job. Let's say you got sick and ill. Let's say bad things happen where you can't make a payment or two. Well, if you only have two lines of credit and you miss a payment, now your payment history goes down to 50%. All right? That's not ideal. It has to be at 90, 98, 99, or 100%. So now how many months will it take you to get back to 97%? Now you can see if you only had two lines of credit and you missed a payment, it's going to take you 7, 8, 9 months to get back to 97%. Whereas if you had 10 credit cards or lines of credit and you missed a payment, that means now you are at 90%. So it's easier now. It'll take you 1 month, 2 months to get back to 97%, and you go on about your business. Your score is going to go down 60, 70 points, but at least you can get those 60, or shall I say, they usually don't give you back all of them, but at least you can get back 50 points or 60 points if it drops 70 points. But you can get back 50 points, let's say, in 2 months. And then you'll be back in good graces, because now you'll be back at 97%, 98%, and 99%, and you'll get there. Because again, remember, you want to be at 98, 99%, or 100%. So in order to get there, the more lines of credit you have, if you mess up and miss a payment, at least you can be back on the right track in 2 months, 3 months. Versus if you only had 2 lines of credit, it's going to take you 8 or 9, 10 months. So that is the difference. So that is the story today, ladies and gentlemen. Thank you again for watching. Thank you for supporting me. I really appreciate it. And please share with everybody. So with all that said, please like, subscribe, and click the bell below so you get the latest updates. And you know it's hard out here. And when the economy goes bad, because it always does in a capitalist society, when you have manipulations going on by printing money, things like that, you're going to need credit sometimes. And the higher your score, the more effective you can be. When you start thinking about investments, when you start trying to take advantage of things, you're going to sit there and wish your credit score was around 750. Because things happen where most people say, I want to be in real estate. And now you don't want to be in real estate at the top of the market, or like now, where generally the price of homes is almost a bubble. But you would love to be in the real estate market if prices dropped 40, 50%. Except what happens when prices drop in 40 or 50%? The borrowers, the financiers, the mortgage companies, they up what your requirements are. So there won't be things like you can have a 600 credit score and get a house. What's going to happen is they're going to go, sure, we'll give you a note, but you need a 700 credit score. Or, well, you can have a 680, but now we're going to add a couple of more points at closing, a couple more points on your interest rate to offset it. And they do things that they wouldn't do in an environment like now. So you're going to wish you had that credit, because things are going to come up where that same house you live in right now could be worth 40%. And you're going to wish that you could say, wow, you mean I could buy this exact same house for 40 or 50%, but yet I can't do it? That's the time that millionaires are made in the real estate game. They're buying at the bottom. That's why anybody who bought property 2006, 7, 8, in most locations, otherwise, in California, you may or may not be above where the 2006, 2005 levels are. But in most states, in most places, if you'd have bought something in 2006, 2007, 2008, you would be doing very well in 2019 and 2020. And the idea is you should sell the house and take your profit and stash it. Okay, and I don't mean stash it in a bank neither, because you're not going to get no 1% or 3%, or you don't get anything on your money. I mean, you better put that thing somewhere where it's liquid, because when banks fail, your money's gone. So you might want to dig a hole. I don't know what to tell you, but you got to make sure you have liquid money, because when the housing goes down and you say, I want to buy a house or a multifamily property, and you have thousands, 50,000, 70,000, 100,000, you're going to find yourself in a situation where not only can you buy one multifamily property, you might be able to buy a single family home, a multifamily properties, and start having money coming in and paying for everything. That's the difference between wealthy people and people who are well off to do. They take advantage when things go down. And everybody, we've been a year and a half into this, and you've had ample time to get everything ready. Just don't be scared. That's all I can say. So, with that said, keep your head up, keep moving, and I'm out.